All right, let's get started. We have a quiz today, right? So if you go to Blackboard, you can see this tab. Right now, there is nothing, but you'll get the link from 3 p.m. to until 11 p.m. So I recommend taking quizzes early if you can, because if you want to wait till 10:30, 10:45, all of a sudden your Wi-Fi is not working, you have no charge in your laptop, then I'm no help. Try to take a quiz early, but you have until 11, okay? When you start it, you're gonna have 12 to 15 minutes, depending on 4 or 5 questions, okay? Quiz is your own, no books, no notes, nothing. Pen, pencil, calculator, that's it. If you need formula, you can see the formula there. So don't worry about like, hey, if there's any problem, how can I solve? Do I need to memorize any formula? It should be there if you need it. If not, concepts, that's on you, okay? Questions? All good. In the last class, we basically stopped, I think, here, right? So now tell me, how much OCF you got? Yes. 1321. So basically, what is our EBIT from here? 1014 plus 500 minus 190, right? Okay. CapEx or net capital spending? $433. That's all you got? Okay. So how much is this fixed asset? 2194 minus 2261, right? That's 500. Okay, 23. Sorry. What else? Our next is change in net working capital, right? How much you got here? 382. 382. What is the working capital for 2018? 18? This one? And what is for 2017? 1426 should be 382. Okay. Now, how much is our cash flow from asset? From this, we have to deduct these two, right? 506. How much is cash flow to liability holders? 136. How much is interest payment? And how much is net new issues? Negative. So basically 538 minus 581. That should be 126. Cash flow to equity holders. dividend is 460, right? If we sum them up, cash flow to liability plus cash flow to equity should be 506. You all got that? Then good job. Moving on. What is the shareholders' equity from here? We don't know. How much? 685. What about others? 685. Anything else? How we have to solve this problem? So we have common stock 97. We have paid-in surplus 340. Is it shareholders' equity? Is it total shareholders' equity? Yes, no. Yes. So if we sum them, 340 plus 97. That should be 437, right? Is it right? Or you told me 685, right? You told 685, right?
Because it also contains retained earnings.
We have that information here.
No, but you have the assets. and liabilities.
Absolutely. So shareholders' equity is basically a function of what? We go back. Shareholders' equity, function of common stock, paid-in surplus, and retained earnings, right? So there are two ways you can solve it. If we know common stock, paid-in surplus, and retained earnings, we are done. But in these problems, we don't have the information for retained earnings. How we can do? We can use the classical equation, asset equal to liabilities plus equities, right? From the total asset, we can deduct liabilities so that we can get shareholders' equities, right? We go to the problem again. Okay. So this is wrong. What I did is completely wrong here. How much liabilities we have? 445? Missing here. Yes, 445. How much asset we have?
1,100.
460 plus 670. How much is that? 1,000. Okay. So if you deduct 130 from 415, you should get 685. Right? So first of all, you have to think about, do we have full information or not? Okay. If we want to calculate equity from common stock and retained earnings, we don't have the full information here. So any questions? So we are done with chapter 2. Now moving on to chapter 3. So what we learned from chapter 2? Balance sheet, income statement, cash flow statement, right? So this picture is not new again, right? We know that, right? So we know balance sheet, we know income statement, right? In the last class, we were more concerned about calculating cash flow from assets and cash flow to liability holders and equity holders, right? This is not what statement of cash flow shows you. Statement of cash flow basically shows the usage and sources of the cash of your corporations. But in finance, we actually concern more about cash flow from assets and cash flow to liability holders and equity holders. So let's talk about a little bit about statement of cash flows and what it does. When you talk about statement of cash flow, it basically shows you sources and uses. What could be some sources of cash flow? So when you talk about sources of cash flow, we basically means cash inflow. How can we generate some inflows? If we sell something, if we sell our products, we can generate some cash inflow. How can we generate some cash inflow? If we decrease asset accounts. Let's say we don't want to invest more in accounts receivable, inventory, or fixed assets. We can generate some cash inflow, right? How can we generate some cash inflow? If we increase liability account, we want to borrow more. We want to generate some accounts payable so that we will pay them later, right? That will create some inflows for the corporations. How can we do some outflows? When we talk about the usage of cash flow, we basically talk about the cash outflow. What are some examples of cash outflow? If we buy something, maybe we're buying land, maybe we're buying plant. We are paying for cost of goods sold. If we do that, those are cash outflow. What are some other examples of cash outflow? If we increase asset account, or if we decrease in liability account. Let's say we are paying dividend, we are paying all those outstanding amount to stockholders, bondholders. Those are some cash outflow examples or usage of cash outflow. What statement of cash flow do? Summarizes the sources and uses of cash flow. That's it. And they actually summarize in terms of 3 activities: operating, investment, financing. Operating activity is all about operations. From the operations, how much cash we are making, how much cash we are paying. Investment activity is all about investment in fixed assets. And financing activity is all about financing from both stockholders and bondholders. Statement of cash flow basically summarizes broadly these 3 different activities, and they actually show you inflows and outflows. But in finance, we are more concerned about OCF, cash flow from assets, cash flow to liability and equity holders. This is a typical example of statement of cash flow. If you look, this side, this is all about operating sources and uses of cash flow. Your investment in fixed assets. This is financing. If you look carefully, this includes both liability holders, debt holders, and also equity holders. So in statement of cash flow, they actually combine cash flow to equity and liability holders under financing activity, whereas they actually segregate cash flow to asset to operations and investments. Any questions? Yeah, okay, I can tell you that. Yeah, I feel like I dropped something. Any questions? Okay. So far what we did, we looked at different statements. We looked at different statements in absolute numbers, right? We looked at like, okay, total asset could be 1 million, total asset could be 1 billion. What is the problem if we look at statements in absolute numbers? Any idea? If we just look at any financial statements of any corporations in terms of absolute numbers, what is the problem?
It would be real difficult to compare between larger companies and small companies.
Absolutely. It is really difficult to compare with the peer groups, right? With the competitors, right? It is also difficult to compare the same corporation over time. Whether they're growing, whether they are not growing, how they are performing, it's really tough to compare. To solve this problem, we can do two things. One is common size, and the other is ratio analysis. So today and in the next class, we're going to go over common sizing and ratio analysis. So what is common size? When you talk about common size, we are actually converting all those raw numbers into percentage, or into fraction, or into relative numbers. In short, converting those raw numbers into percentage. How can we do that? For balance sheet, we converting all of those raw numbers in terms of total assets. In income statement, we are converting all of those raw numbers in terms of sales. So now it is easy to compare over time and also easy to compare with the competitors or peer groups. Let's look some examples. If you look here, total asset should be 100%, right? Because asset over asset is 100%, right? Now all these raw numbers are converted to percentage, right? 2017, you can see that these corporations hold 2.5% of your total asset in cash. If you think about this number, this corporation hold 19% of its total asset in current assets, and 81% of total asset in fixed asset. Now, if you look these numbers, you can say that, okay, so they are getting money from the investors. And then 80% of the money of the total asset, they're investing in fixed assets to generate profit, right? To generate return, and 19% for liquidity. Make sense? Now, how can we explain this number and how can we explain the changes? Because it's the same thing converted to relative numbers or percentage in 2018 values. What is the interpretation? If you only look at 2018 numbers, interpretation is same. 20.8% of total asset in current asset and 79.2% of total asset in fixed assets, right? But if you look at the changes, what you can think of from there? Do you see any changes? Yes, Isaac. Right. So what the corporation is doing, putting more money in the current asset, putting a lot more money in cash, right? How? Reducing money in fixed asset, right? So this is the liabilities and owners equity side. 2017 value, 2018 value, all converted to percentage in terms of total assets, right? How can we interpret current liabilities. 16% of total asset in current liabilities, right? And 15% in long-term debt. 14% from issuing common stock. 52% is from keeping the retained earnings, right? That's how they're financing, right? So if you compare, I believe 68% is basically from total equity, and remaining 33% is coming from total liabilities, right? Same interpretation here. If you only look at 2018 values, but if we look at the changes, what we can see here, or you can talk, how can you explain? If you look at the changes. What is the interpretation? If you look at the changes, what they are doing in 2018 that is different from 2017.
Paid off some of their notes payable, just kind of reduce their, um,
Okay, yeah, good. What else? Yeah, absolutely. What else?
increase their retained earnings.
Yeah. What else? Absolutely. So they're actually trying to reduce their liability exposure as compared to total asset, right? And as a result, their equity exposure is going up. Maybe they're trying to keep more retained earnings, right? So this is giving us easy way to compare, right? Raw numbers don't give us to explain, to compare over time, and also compare one corporation with the other, right? So this is one of the benefit of common sizing. Income statement. This is also common sized in terms of sales. So that's why sales is 100%. Cost of goods sold, the direct cost of producing any product, right? So you can say these corporations basically have 58% of cost as compared to sales, right? If they generate $100 in sales, they also accrue or occur 58% for producing those sales, right? Depreciation, fixed expense, 11% of sales, almost total. Your EBT or EBIT or operating profit is around 30% of your sales. This is also known as operating profit margin. When you compare or when you convert our EBIT or operating profit in terms of sales, this is known as operating profit margin. We can say that by doing the business, the corporation is generating around 30% of operating profit in terms of sales. 6% of the sales goes to interest payment. And then around 5% of sales goes to tax payment. And finally, you can keep 18.8% of your sales as net profit, right? Or net income. This is known as net profit margin. What is the benefit of common sizing? If we have multiple years, we can compare whether the firm is able to generate more profit margins or not. Or we can compare two different firms, who is better in terms of profit margin, right? So common size gives us that strength to compare over time or with other corporations. you can look here, the usage of net income. 6.3% of sales going for dividend payment, right? 12.5% of sales is kept or retained within the corporations. You sum this two, you get the same value. Questions? Any questions about common sizing? Then let's do this example. And let me know the answer. Get done. Okay. Who wants to volunteer? How much you got? Yes,
11.1%
for,
inventory.
okay. So basically inventory is 88, right? And total asset is 518 plus 274. Right? Good. What's your name?
Alex,
Alex. Okay. Wants to volunteer for net income. Yes, guidance.
So we have 213, over sales. To the income statement. That's gonna be 1090,
230 over 1090.
that will be about 19.5%.
This is all you got. So you can interpret 11% of total asset is held as inventory, right? And 19% of or 19.5% of sales could be kept as net income, right? After paying all of costs, all of direct costs, interest, tax payments, right? Okay, so moving on to ratio analysis. So common size have some problem because common size only gives you information in terms of total asset or sales, right? But we want to know more information about the corporations, right? We want to know a lot of other things, a lot of other profitability, a lot of other debt ratios, a lot of other liquidity ratios, right? Most of the cases, common size don't give you all of those informations. To know more about the corporations over time and to compare the corporations with some other corporations, ratio analysis is one of the best tool we have. So what are some ratio analysis we can do? We can talk about short-term solvency or liquidity ratios. We can talk about long-term solvency or financial leverage ratios, asset turnover, profitability, and market value ratios. These are some tools or examples of liquidity or short-term solvency ratios. The most used, most widely used is current ratio when you talk about liquidity ratio. How can we calculate current ratio? It is current asset over current liabilities, right? Current assets 2168. Current liabilities 1995, right? Now, what is the interpretation? This 1.09 is telling you the corporations have 1.09 times of current liabilities in their current assets. It signals you they have sufficient amount of current asset to pay current liabilities, right? It is always advised you should have at least 1 for your current ratio. Otherwise, it's a bad signal for your financial health for short-term solvency or short-term liquidity. Because when the current ratio is below 1, what does it mean? You do not have sufficient current assets to pay your current liabilities. Always advisable to have more than 1, but there is no range like how more, 3, 4, 5, 6, 7, no. At least 1 or more. If you hold more of your asset in current assets, you are losing the opportunity to invest in fixed asset to generate return, right? So you should have at least 1 or more so that you can pay your current liabilities when needed. Make sense? So any questions about current asset or current ratio? So if you look carefully, is it similar to something else we are doing so far from last class? Just look at the formula. Is it similar to something else we have calculated? Yes, absolutely. Your name? Michaela, absolutely. So working capital is current asset minus current liabilities, right? So this is just the ratio. When we have current ratio of 1, what is the interpretation? We have 0 working capital, right? So if current ratio is 1, that means 0 working capital. When we have current ratio more than 1, what you can say? Our working capital is positive. Less than 1, working capital is negative. So current ratio tells you your capacity to pay short-term or debt or current liabilities. Also, it also gives you some information about your working capital investments. But there is a problem with current ratio. It is not always give you a good idea of your short-term solvency. Any idea why?
So your current assets might be a little hard to sell.
Why? It's current asset, liquid assets. Why it should be hard to sell? It's not my property, it's not my land, right? It's not my plant. Why?
Like accounts receivable is a current asset, but that's money that is called an on-account function.
Okay, and what else? The major problem of current ratio or in current asset is inventory. Depending on the nature of your business, your inventory could be liquid, your inventory could not be liquid, right? So accounts receivables are not as liquid as cash, but they're pretty liquid because you can go to some financial institutions and you can pledge those and get some cash from there. So you can factor accounts receivable to generate some cash. So accounts receivable kind of liquid, very good quality liquidity, but problem is inventory. Let's say you do nuclear weapon business. How liquid is your inventory? No? Yes. Let's say you do consumer staples. At least better liquidity than nuclear weapon, right? If you compare the inventory of consumer staples versus compare the inventory of nuclear weapon, what do you think? Which one should be more liquid? Consumer staples, right? Because product in Casey General Store, Walmart, easy to sell than someone selling weapons, right? So in those cases, two different corporations could have same current ratio, but they are not same liquid, right? Because their inventory is difficult to sell or easy to sell depending on the nature of business. And that's why sometimes we prefer quick ratio better than current ratio. Because in quick ratio, you can see current asset minus inventory over current liabilities. So we're taking out the inventory. Now we have cash and accounts receivable. they are kind of comparable across different companies, right? So now this giving you better signal. There is no threshold how much quick ratio we should have. Higher is always better, and higher is a sign of better liquidity. But there's no threshold how much we should have. But for current ratio, at least one. That's the threshold. This ratio is also known as acid test ratio. So any questions so far? Current and quick. So it's easy to calculate. If you go back home, use these financial statement values, current asset, current liabilities, inventory. We are just using the same values to calculate ratios here. Okay, moving on. Cash ratio. Sometimes you can think like accounts receivables are not as liquid like cash, right? So that's why sometimes you want to look at cash ratio. And this is the most liquid ratio any corporations could have. Because this is just the cash in your account. You can just use it right now to pay your liability, right? Because there's no receivables, no inventory. You don't need to bother about how to sell those inventory, how to factor those receivables with financial institutions to get some cash. No. Cash ratio is all about cash over current liabilities. No threshold, how much we need, but higher the value, better signal for short-term solvency or short-term liquidity. Sometimes people prefer to use that net working capital to total asset. So this is another version of liquidity ratios. It's basically trying to tell you how much of your total asset is kept in net working capital investments. Higher the ratio, better the liquidity. The final ratio that captures liquidity is known as interval ratio or interval ratio. This is very intriguing. The interpretation is very intriguing. If you look at the formula, current asset over average daily operating cost. Current asset over average daily operating cost. So we know the current asset value. Operating costs are all costs excluding depreciation and interest payment. Operating costs are all kind of costs here, including depreciation and interest payment. Going back, income statement. Cost of goods sold, expenses. We're only considering these two. We are not considering depreciation, not considering interest expense. Only considering these two values. Okay, so look at these two values, then converting them into daily values, divided by 365. Because 365 days a year, right? Converting them to daily. So if you look at this ratio, what is the interpretation? Current asset over average daily operating cost. What is the interpretations? You have, or these corporations have 211 days of operating cost in their current assets. If they want to run the business for 211 days, the cost they need, they have it in their current assets. without going for any additional financing, without going for any new issuance, they can run the operations for 211 days. More the ratio, better it is. They have more current asset to run the business for longer without going for additional financing. Questions about short-term solvency or liquidity ratios. These are some ratios that's trying to tell you the corporation's capacity to pay current liabilities very quickly. That's it. In real life, what we do in real life, we try to compare same firms' liquidity ratio over the years and try to look at whether the liquidity have changed or not. Okay. In real life, we try to compare one firm's liquidity ratio for a given year with the competitors for a given year and try to find who is better in terms of liquidity. Because if there is any obligations occur, who will be more solvent in short term? So for liquidity ratios, you can memorize the formulas, which I don't require for this class. Formulas will be always given, but what I want you to learn is the interpretations. To learn more better, go to Bloomberg. Get some ratios, real ratios of some real corporations. If you don't want to go to Bloomberg, go to Yahoo Finance. Sometimes they show you some real ratios and try to look at different corporations, how they're doing in real life. These are all inflated values, right? Just created values. These are not real values, right? Go Bloomberg, Yahoo Finance, some other sources, find out some of your favorite corporations, maybe Walmart, maybe something else, and look at how the liquidity is. Over the years, is going up, going down. During COVID, what happened? Try to explain. I'll not test the formulas in my class, but explanations. Questions? All good? Now, from short-term solvency, we are moving to long-term solvency. So long-term solvency try to capture what is their long-term debt or total debt ratio in terms of asset or equity. So when we talk about total debt ratio, look at here, total asset minus total equity. So that means this is what? Total liabilities, right? Total liabilities over total assets. So this value is nothing but total liabilities. What is the interpretation? 50% of your asset is financed by total liabilities. So that means if I own this share, I'm putting forth 50%, and my bondholders, liability holders are also giving 50%. Now we are owning this share. Debt to equity ratio, similarly, total debt or total liability over total equity. Some books, some professor, or some analysts prefer only long-term debt to total equity ratio when they want to analyze debt to equity ratio. But ideally, same interpretations. If you look at here, you have 1.03 times of your total equity in your total debt. You have kind of more total debt, marginally more total debt from your total equity in the total asset. Equity multiplier. Total asset over total equity. So this is trying to tell you how much leverage you are taking. Total asset over total equity. For $1 of your equity, you have $2 of asset. For $1 of your wealth or equity, you have $2 of asset in the corporations. Finally, long-term debt ratio, which is long-term debt over long-term debt plus total equity. So what is the interpretation when we talk about long-term solvency ratios? This is actually trying to tell you the leverage in your corporations. Okay. So do you think leverage is better or not? Do you think leverage is better? More debt is better? Yes, no? Who believes leverage is better? No one? Debt is not good. Why debt is not good?
Company goes under, you still have to pay all your debts.
Okay. But if I'm making a lot of money, then I'll only pay some interest on, right? This is good or this is bad. On an average, debt is not good for your corporation. But going forward, we'll talk about specific situations why debt is good. Debt definitely has some benefits for the capital structures. Because if you read newspaper, you can see a lot of corporations, big corporations like Apple, they're issuing bonds. If debt is not good, why they're issuing bonds, right? We will talk about that, why debt is good, why debt is not. But on an average, in a normal situations, higher debt is not good for your corporations. Why? If you have debt, what do you have to do? You have to pay a fixed interest each year, right? Doesn't matter. You are generating a lot of profit or not. You have to pay that amount to the bondholders or debt holders. If you don't, you will be sued, you will be filed for bankruptcy, right? So that's not good. So that's why these ratios are trying to give you the results, how much debt, how much leverage you have in your corporations. And if you can look it, you can say that for these corporations, they're using 50% debt and 50% equity, which is a little bit high, right? So for similar corporations, you can look over the years whether their debt is going up or not. You can also compare these corporations with the competitor or peer to see who has lower debt. If you have lower debt, you have financial flexibility because you don't have interest burden. Now, for most of these ratios, different professors, different books want to do it differently. Let me tell you why. When you talk about total debt versus long-term debt, can you tell me what is the real difference between these two items? When you talk about total debt versus only long-term debt. No idea. Yes. Gabby. Okay, absolutely. Then what is the problem of including accounts payable?
Well, it's just like a link or something. That's very.
Okay. Let's go to MLE.
It'll be paid off like the.
Then what is the problem? It's still a liability. You have to pay it off, right? What else? Yeah, we both are like short-term in nature, right? That's fine. What else? If accounts payable is there, what is it? What is the issue? That's why short-term nature is fine. What is the issue? What else? Do we pay interest rate in accounts payable? Do we? No, right? Do we pay interest rate in long-term debt? So the idea is when you're talking about all this kind of solvency or major problem, those kind of leverage comes with fixed burden, right? Equity doesn't come with fixed burden, right? You don't need to pay dividend every year, right? But for interest, you have to pay. So the issue is why different professors have different opinions, different thoughts. In total debt, you have accounts payable. It doesn't have any fixed burden, no interest payment, right? But long-term debt has interest payment, fixed burden. And if you can't pay it, bankruptcy. So that's why sometimes people want to see total debt ratio as well as only long-term debt ratio. The same equation, all of the same equations, but by changing total debt with long-term debt. They are giving same information, how much leverage your firms have, but they're trying to distinguish interest burden debt versus non-interest burden debts. Make sense? So any questions? Yes. Gabby.
Do any of these ratios have like the thing like the short-term solvency where you want them to be like less than one or greater than one? Or something?
There is not a fixed, there is not a good question. There is not a fixed thresholds. Okay, there's not a fixed threshold because there have been research for last 30, 40 years, like what is a right capital structure? How much debt we should have, how much equity we should have, okay? And there is not one single answer. What is the right capital structure? So we're gonna talk about it. Maybe, I don't know, maybe chapter 7 or whatever. So that's why there's not a fixed threshold. It's totally depending on what you want. But the thing is that more debt will reduce your financial flexibility. So depending on your nature of business, the capital structure you want, you can think about what you want. Anyone else? Okay. So we're done with short-term and long-term solvency. Okay. Now we are moving on to interest coverage ratios or coverage ratios. So these ratios trying to tell you your capacity to pay interest amount. The capacity of the business to pay interest. If you look here, there are two ratios. The first one is times interest earned, which is EBIT or operating profit over interest. Going back to income statement, EBIT over interest, right? Now, what is the interpretation? This ratio is trying to tell you from your business how much operating profit you are generating pay interest. If you look carefully, you are generating 162 times of profit, operating profit from your business to pay interest, right? Higher the ratio, better the capacity. Because after you generated operating profit or EBIT, what is the next step? Pay interest. What is the next step? Pay interest. So that's why higher the ratio, better the capacity. So this is good for the debt holders. If they say you, good for the debt holders because you can pay 162 times. That means if it's the annual value, you have 162 years of interest payment of your this year operating profit. What is the drawback of this ratio? EBIT contains non-cash expense, depreciation, right? if we learn from the last class. EBIT contains non-cash expense depreciation, right? So that's why we're trying to add back depreciation. Think about the cash figure of your operating profit. Because for depreciation, we already bought the asset before, now we are depreciating each year. This is not reducing our cash flow, right? So we are converting to the cash figure or cash equivalent of our operating profit, and then looking at the same ratio. And this is giving us a zero value. In terms of cash coverage, interpretation is you have 170 times of operating profit from your corporations to pay interest. Questions? Good so far? Okay. Final ratio for the day. Inventory ratios. This is also known as efficiency ratios. So going back 2 classes. Matching principle. What is matching principle? Yes.
You have to match all your revenues. with expense.
Okay, absolutely, yeah. Your name?
Yeah.
Okay, absolutely. So according to matching principle, what do you have to do? Each year, how much sales we are generating, we have to match the expenses we occurred or accrued for that amount of sales, right? So this cost of goods sold is telling you for a certain year how much cost you accrued to generate certain amount of sales, right? So if you look carefully, income statement values, balance sheet values, right? If you compare carefully, you can see that you're holding certain amount of inventory each year to make sure your sales are smooth, right? Why you hold inventory? To make sure sales are smooth. Looking at cost of goods sold, this is telling us how much we occurred to generate sales each year, right? So this ratio is comparing, or this ratio is telling you each year to generate certain revenue smoothly, how much inventory you're holding. This is explaining your efficiency. For a similar amount of sales, if you hold more inventory, this is not a good efficiency, right? If you hold less inventory, this is a better efficiency, right? So this is nothing but a proxy for your sales, because we know that cost of goods sold are matched with sales, right? This is basically a proxy for your sales. This ratio is telling you to make sure smoothing sales, smooth the revenue, how much inventory you're holding in the year. More inventory you hold, it's not a good efficiency. Less inventory you hold, better efficiency. So this ratio is telling you you are basically holding 4 times of cost of goods sold of your inventory. For $1 of cost of goods sold, you have inverse 1 of 4 inventory. To generate around $4 of sales, you're holding $1 of inventory. The lower you can hold inventory, more efficient you are. So that means higher the value, more efficient you are. Make sense? This ratio we are just converting to in terms of days. This is telling you to convert from inventory to sales, the entire process takes around 91 days. lower the value, better efficiency in terms of days. Because you're taking less days to convert from inventory to sales. Make sense? Higher this value is better. For a similar amount of sales, you're holding your inventory. That is better. But lower this value is better because you're completing the whole cycle, whole process in lesser days. So these two ratios is basically trying to estimate the efficiency of your production cycle process from inventory to sales. Now, one caution for all of your ratio analysis, one caution. Income statement item, balance sheet item. Going back to income statement definition, income statement shows everything done over a period of time, right? Balance sheet shows everything on a certain point in time, right? That's why if you're calculating any ratios using income statement item and balance sheet item, the best solution is average inventory. Take the average value of balance sheet item or ending value of balance sheet item. First solution, if you are doing any ratios where numerator has income statement item, denominator has balance sheet item, then take the average value, which is beginning plus ending divided by 2, right? Take the average value. If not, you can either do beginning, you can either do ending. But whatever you are doing, make sure you are consistent. Let's say you are calculating inventory turnover for one corporation for 5 years. Okay. So if we are doing average balance sheet items, do the same process for 5 years. If you're doing the ending balance for the balance sheet item, do the same process for 5 years. Make sense? Although this is the most recommended, but you have some freedom. But whatever you are selecting, do the same thing consistently year over year. Makes sense? Okay, that's all for today. You have a quiz. Good luck and take the quiz.